So when you are unfortunate enough to have one, my advice is to do some sidestepping of some of the pain. Value stocks outside the US are not too bad. You can expect, if you put them away for 10 years, to make a respectable, even if it's sub-average, you should make a respectable return. Yeah, if you can lock up your portfolio, throw the key away, you'll probably do okay. The problem is if you hit these super bubbles that concern me, these 3 sigma outliers, in 1929, you didn't get back until 1956. And in 2000, you had lost a lot of money by 2009, and you got back in the game about 2012. And the same with the housing bubble. You can have a long wait. The mother and father of all equity bubbles is Japan in 1989. And they're still waiting. So that's 22, 23 years, and they're still not back to the high. And what happens in real life is people don't hang in and wait for the 40-year return, in the case of Japan. They change their strategy and abandon ship as the market goes down, more often than not. So these are very dangerous events, and you don't want to ride through them if you can avoid them, and they're not that common. So when you are unfortunate enough to have one, my advice is to do some sidestepping of some of the pain. Yeah, about 25 years ago, we felt in order to talk about bubbles, we should probably define them statistically. And so we did just that, and we picked a standard statistical term of a 2 sigma. A 2 sigma event is the kind that should occur every 44 years in a perfectly random world, and with human beings who are capable of being a little inefficient. They occur every 35 years in the equity markets. Close enough, I would say, for government work. And we noticed that all of them in the developed world, in modern times, in equity markets, went back to the trend. And the trend is easy to measure. The 2 sigma is pretty straightforward statistics. And the fact that all of them went back, without exception, we find a very compelling idea. The complexity comes from the fact that some of these 2 sigma events continue to go up. And 3 of them in the US have gone up to 3 sigma, which is the kind that you would expect every 100 years. But as I like to say, humans do seriously crazy pretty well. So they are much further away from random than 2 sigma. And 2 out of 3, certainly more than half of 2 sigma go on to 3 sigma in recent times. And the 3 sigma events we have 1929, 2000, and today in the equity market, and Japan as a major market overseas in 1989. And it doesn't change the outcome. You go back to trend. But since by definition you've gone further up, it takes longer and more pain to come down. And the quicker the bubbles end, the better off everybody is. And we mentioned that this one was at 2 sigma back in July of 2020, or August, about 3,500. The trend line is about 2,500, 2 sigma is about 3,500, and 3 sigma, 45, 4,600. We got to 48 in December. And if you're going to have a bubble, it's better to break from 35 to 25 than it is to break from 48 to 25. And therefore, the real McCoy super bubbles are extremely painful in terms of a reduction of perceived wealth. And there is a wealth effect. When they muck down your portfolio or your house, you spend a little less in the following year or 2. corporate buybacks have been the shining number one driver of this 11-year bull market, and has changed everything. And then with the stimulus program, of course, the individuals came back quite suddenly, and in many cases unexpectedly. Not just unexpectedly in the numbers and the amount, but in their style. The meme stock style of investing is something no one has ever seen before, happily. Hopefully we'll never see it again. But to take basically worthless stocks like GameStop up 110 times in a month, and 40, 50 times for AMC, the movie chain. These are levels of craziness that we had not seen in 1929 and even in the pet.com era, in my opinion. There was more money involved, bigger moves involved than we had ever seen. But get back to your point. So individuals came storming in at the end, buying their own stocks by hand, not moving into institutional type mutual funds. And the whole time, corporations were buying their stock back. Why wouldn't they? It's a safer way to invest their cash flow than developing new ideas of their own. And they would rather go out and buy a company from the venture capital industry. That's a capital transaction. Why would they risk income transactions by developing their own new ideas? So they're basically outsourcing to the venture capital industry. And that's the same kind of attitude that is represented by buying your stock back. You know exactly what you're getting, you know what it costs, you know what the effect is, you get rid of the weak holders of the stock, and it helps push the price of the stock up. The fact that it should not in an efficient world is irrelevant. In the real world, you get rid of weak holders, and steady buying pressure on stocks pushes the price-earnings ratio up, and their stock options benefit. 85% of their remuneration comes from direct stock grants and from stock options. Why would they not put management of the share price as a top priority? I avoided the word manipulation, but I was very tempted to use it. Yes, I think the 60-40 portfolio is disastrous looking today. And we have many asset allocation funds at GMO called benchmark free and so on, which attempt to make a decent return without regards to a benchmark. And it twists and it turns and it tries to be as ingenious as it can to own bits of paper, fixed income feeling, where there's some extra way of making some return, some use of your brain power, some alpha that can be put into the pot. Value is pretty darn cheap compared to growth. And the US is about as expensive as it gets compared to other developed countries. So non-US equities are oddly semi-reasonable. They're overpriced, but they're not too bad. And one or two of them, like Japan, the UK, are really not materially overpriced even, which is unusual. With the US, not unique, incidentally, 2000 was rather like that, but it's unusual to have such a big disparity between one euphoric market and the rest of the world being relatively serious and more ordinary looking. Emerging obviously has some problems or question marks with China, but emerging in total looks very much cheaper than the US, about half price. And the value component is cheap within emerging. So value stocks outside the US are not too bad. You can expect, if you put them away for 10 years, to make a respectable, even if it's sub-average, you should make a respectable return. The US, I suspect you'll make no money at all for 10 years. And you have to find the kind of moral equivalent in fixed income, other ways of investing your money.